So it's been 2 years. I was speaker in London 2 years ago, March 20. Flew back on the airplane to London by myself. And that's close. And it's great to be back and we've been able to change these rules so we can now continue to Zoom along with in person. So a lot of people signed up for Zoom, so that's going. The calendar screen is up there. So welcome back, and it's great to be here. And so we'll be doing that going forward. We'll be doing on person and Zoom, and there may be some just Zoom. Right now, the plan is to just do both. So tonight is the first salon in what I hope to be a series of salons to explore the relationship between the dollar and the reserve currency. Our reserve currency status has allowed our government, the U.S. government, to borrow $7 trillion. Went back and forth on what the exact amount was, but it's $7 trillion foreign yeah. And it also allows, unfortunately, it allowed us to weaponize our currency. And just as the Bank of England financed the British Empire, the U.S. Treasury borrows staggering sums of money that help finance our endless wars and finance our massive military spending. If either the Democratic or the Republican Party asked the American people to put the bill through large tax increases, political competition over guns and butter might suddenly break out. When Great Britain tried to tax us to pay for the French and Indian War, we fought 8 years for independence. To facilitate our calamitous entry into World War I, and shortly led to World War II. Tax increases were avoided through Liberty bonds, multiplied, exploded our national debt by more than 20 times. Today, the Fed has become the largest buyer of U.S. debt. Now, tonight, it's great to have Warren Coates here. Warren was a top leading economist at the IMF for a career spanning over 3 decades. And as a salon member, it's clear that he was the right person to kick off our salon series on the reserve currency. Warren was chief of the, at the IMF, he was chief of the what's called special drawing rights, SDRs. He was head of the IMF operation unit in the 80s, and today he's a, let's say, advocate for replacing the dollar in international trade and finance with SDRs. In September last year, 2021, the IMF member states tripled SDRs to almost $1 trillion. So that was the landmark development. Now, Warren will explain the unique role the dollar plays internationally, how anything can't go on forever will end, and will explain to us why he thinks his alternative, SDRs, will make the United States a better place. Warren, that's all it is.
I'm quite grateful and thrilled to be able to stand in front of you and share some of my thoughts. In our multi-currency world, the dollar is widely used for pricing international goods, for international payments, for denominating assets, that governments and companies hold in their reserves. The question is, why is that? And what are the implications for U.S. behavior? What would a better system look like? In a world of many different national currencies, the payments for international trade has found economy in using an intermediate so-called vehicle currency to facilitate exchange of the buyer's currency into and delivery of the seller's currency. Following the collapse in 1971 of the dollar-based gold exchange standard, overseen by the International Monetary Fund, the dollar continues to dominate in this role. This role has given the United States important political power and financial benefits, and I want to review those briefly with you before getting on to the SDR alternative. I will quickly review these benefits, how they came to encourage the U.S. to exploit them in exercising its international power, the forces that are building to seek an alternative, which we read about in the press every day between China, Russia, and Saudi Arabia, and others, and the potential for the IMF's special drawing right, or SDR, to provide an alternative. Cross-border commerce and investments require a common currency to price and denominate them, and the mechanisms for cross-border payments. While modern technologies continue to increase the speed and ease and lower the cost of domestic payments in domestic currencies, cross-border payments remain relatively slow and costly. Some economy is brought to the cross-border market for foreign exchange needed for these cross-border payments by using a common so-called vehicle currency as a common go-between. To get the idea of why that is, think of the adoption by airlines of a hub and spoke model by which they connect all airports in the country or the world through consolidating through a hub and spoke kind of model. This is very similar to the vehicle currency role played by the dollar. The US dollar is the most widely used vehicle currency for this purpose. There are the euro also, and a few others, but it overwhelmingly dominates. This is supported by and reflected in the dominance of the dollar in invoicing internationally traded goods and in the foreign exchange reserves banks, both central and commercial, around the world hold. The euro is the second most widely used currency for this purpose. To pay for things with a currency, one must hold some amount of it. It is this demand for dollar reserves resulting from the widespread international invoicing and payments in dollars that underlies the foreign financing of U.S. debt. For starters, about half of the U.S. dollar banknotes, the actual physical currency, are held abroad. And not overly surprisingly, the overwhelming predominance of $100 bills are held abroad. That is the extent, the holding of banknotes abroad, to which we pay for imports with cash the sellers simply hold. Almost a free deal. Foreign central banks hold about $13 trillion in foreign exchange reserves, of which about half, $7 trillion, is in US dollars. Much of that held in the form of US government debt. About 60% of the foreign currency claims of banks are also dollar claims. The dollar grew into its vehicle and reserve currency roles because of the size, and these are important elements that underlie its wide acceptance and use. because the size of the U.S. economy, its extensive trade with the rest of the world, the size and liquidity of financial assets denominated in dollars, and public confidence in the stability of the dollar's purchasing power, and in the world's trust in contract enforcement, in other words, the rule of law. The so-called exorbitant privilege of a reserve currency, the ability to borrow abroad in your own currency, makes it easier for the U.S. government to finance its military and other expenditures with debt, because an important amount of that debt is held abroad. Foreigners are lending to Uncle Sam. For countries to accumulate dollar reserves, they must have a balance of payments surplus, which somehow one of our previous presidents didn't think was a good thing. And they must sell more to the U.S. than they buy from the U.S. As a result, Americans enjoy cheaper imports, and the excess of dollars paid for such imports over those paid back for U.S. exports are held in foreign exchange reserves. In other words, this is the extent to which the rest of the world is financing our public debt. The U.S. dollar's dominance in global trade and finance contributes to the existence of the American empire in two important ways. It attracts foreign financing, as I have mentioned, of the U.S. government, and its military industrial complex, thus reducing the burden of the empire on the American taxpayer. And it provides a tool by which the U.S. can impose its will on other countries and individuals in managing its empire. To look at each of those quickly, what I call weaponization of the dollar, and John used that same term. The U.S. has abused the importance of its currency for cross-border payments to force compliance with its policy preferences not always shared by other countries by threatening to block the use of the dollar. We're seeing that in spades today, with the very important difference that the U.S. is not acting unilaterally this time. They're acting in harmony with most of the West. The other important factor is the growing risk of a decline in the dollar's value. So two basic factors that are challenging and threatening the dominance of the dollar in international reserves, the fact that the U.S. abuses the power that comes with that to impose its will on other countries to blocking the use of the dollar, and the growing decline in the dollar's value. The growing expectation of dollar inflation is one, and the skyrocketing increase in U.S. fiscal deficits are increasing the risk of holding and dealing in dollars. How serious that risk will get, where it will go, we don't know, but clearly that risk has been climbing, making more countries more cautious about loading up with dollars. The first factor, weaponization of the dollar, has been growing in importance as the U.S. has increasingly sanctioned trade in dollar payments without broad international support. Think of Iran. The EU has sought workarounds in Europe. China and Russia are building an alternative payment arrangement using China's renminbi, and others are looking to see India is now in discussions with China on alternative payments to dollars. The second factor has never been taken very seriously until now, the second factor, potential weakness in the value of the dollar, At the end of February of this year, last month, the U.S. national debt was over $30 trillion, or about 25% of U.S. output measured by gross domestic product. Federal government interest payments on its net debt were this last year $426 billion each year. But with the increase in inflation and interest rates rising, Uncle Sam's debt service payments are likely to double or triple over the next 5 to 10 years, rising to from 15 to 20% of the federal budget. Yeah, that becomes a serious constraint on other spending. The world still expects the U.S. to regain control of its spending, and so do I, because I'm an eternal optimist. But the risks of default are creeping up. An internationally defined and issued currency, unlike the renminbi or the euro or any other national currency, would have several advantages over the use of the dollar or some other national currency for cross-border payments. In a small step to create an internationally issued currency, the International Monetary Fund created its special drawing right, or SDR, in 1969 in the expectation of supplementing the gold-based US dollar. You remember when the dollar had a fixed gold price. The value of one SDR is currently equal to the current market value. So it's how the SDR is valued has changed. So I'm telling you now how it's currently valued. It is currently valued on the basis of the market price of fixed amounts of 5 currencies, these being the dollar itself, which is the dominant one. These are weighted sort of by the importance of each economy. The current market price of fixed amounts of US dollars, euro, pound sterling, Japanese yen, and Chinese yuan, which was newly added 3 or 4 or 5 years ago. Thus, its widespread use for pricing internationally traded goods and financial instruments would provide even greater stability than would any one of these currencies, basic portfolio theory. Every morning, when I check movements in the price of oil, I must ask myself whether it was really a change in the price of oil or in the exchange rate of the dollar. However, the IMF's SDR can only be held and used by major central banks and a few international bodies such as the World Bank or the BIS. Thus, private SDRs, so-called market SDRs, are needed for payments by the private sector. These don't exist in any significant amount. There are a few banks that offer SDR deposits, but it's totally insignificant. These might be issued by banks in the same way banks offer deposits in dollars. Moreover, as an internationally issued currency, the SDR would be far better protected from the political abuse increasingly experienced with the US dollar, and as might be expected from other national currencies such as the Chinese renminbi. So this is another advantage of an internationally issued currency. The SDR currently falls far short as a challenge to the dollar because of the absence of widespread private market use of the unit. So what I'm setting out here is not that the SDR is the ideal alternative to the dollar, but that it already exists and has a recognized, well-defined legal foundation. Therefore, it's the most promising place to start to build. It's nowhere near being what it needs to be an alternative to the dollar, but it's a good foundation to start building. And that building has several elements. Some changes to the IMF's SDR itself that I'll get to in a minute, but largely developing the use of that unit in the private sector. Banks offering what some call MSDRs, market SDRs, or digital SDRs, private SDR, currency to their customers would hold an MSDR reserve backing with the IMF's SDR. I mean, this is similar to the relationship between dollars created by banks and the Federal Reserve, which provides the base money on which that is stood. They should be required to adhere to currency board rules. And if I don't say enough to explain to you what currency board rules are, you can ask me and I'll be happy to elaborate. I have been very involved in the establishment of several central banks operating on a currency board basis, Bulgaria and Bosnia and Herzegovina. And MSDR would can be facilitated by invoicing internationally traded goods, international instruments, and SDRs. What I'm doing now is just describing the ways in which the private sector can and should, for internationally traded goods and so on, use the SDR unit, thereby creating financial instruments in SDRs and building up the private sector part that would be required for the SDR to be a serious reserve currency. More, if not most, internationally traded commodities could and should be priced in SDRs. Why should oil be priced in dollars rather than SDRs? Given this is not a political argument, but an economic argument, given that the value of an SDR being based on a basket of 5 principal major currencies is in fact a bit more stable relative to the goods and services you and I consume than is any one of those currencies, than is the dollar itself. The dollar is not an unstable currency. It's a basically quite stable currency, but a basket that has it and the other 4 currencies is going to be even more stable. Therefore, there's just a good economic argument, plus the neutrality of an international unit rather than a national unit for pricing things like oil. Cross-border borrowing, which is often in dollars, could and should be dominated in SDRs, starting with bond issues and lending by the international development institutions, as is now the case with the IMF, and to a very limited extent, or more limited extent, with the World Bank. I was absolutely flabbergasted that China, when it created the Asian Infrastructure Bank, denominates it in dollars. Their whole operation is in dollars. I don't quite understand that. To go all the way with SDRs, the IMF's Articles of Agreement would need to be amended to replace the allocation of SDRs with issuing them according to currency board rules. Now let's see if you grasp what a currency board rule is here. Such rules oblige the issuer to buy and sell its currency at a set price for its anchor. The anchor that I'm proposing is the SDR. And currency board rules would obligate the ultimate issuer or private bank issuers or others to offer them whenever anybody wants to buy them at that price and to buy them back and deem them when anyone wants to sell them back. This gives rise to a market arbitrage. Think of the gold standard, which is a little bit easier to think of, I think, rather than a basket of things. If the price of gold in the market is above or below the official price, there's an arbitrage incentive to buy it at the better price. Either you're redeeming them and shrinking the money supply in the process, or you're selling it to the central bank because it has a better price and increasing the money supply. So this is the arbitrage mechanism of currency board rules that make the supply of money exactly what the market wants it to be, with no interference whatsoever by the issuer. The central bank does not have a monetary policy. It follows the currency board rule. Furthermore, the valuation basket that now consists of key currencies would need to be replaced with a commodity basket. You can't have many or most currencies in the world fixed to a basket of themselves. You haven't aggregate at all. So you can't have a currency basket if this is broadly accepted. You would need something else, and I think a small basket, not gold, or at least not only gold, but a basket of 5 to 10 commodities that are homogeneous, easily measured, and globally traded, therefore having a global price. The basket would consist of fixed amounts of each of these commodities and their collective market value to define the value of one SDR every day or at every moment if things were volatile enough. There have been similar proposals in the past. This will be close to the final point. There have been similar proposals in the past, but the high transaction and storage costs of dealing with all of these goods in the valuation basket accumulated. However, the arbitrage mechanism encourages if SDRs are issued and redeemed for assets of equivalent value to the valuation basket. So what I'm saying is if you just think of gold because that's easier to think of, rather than actually transacting in gold and storing it and protecting it and all of that, treasury bills of equivalent value would have exactly the same arbitrage potential for regulating the money supply. So you don't. This is what Leland Yeager called indirect redeemability. You don't need to buy and sell the actual commodities in the basket. They're just there to give you a benchmark for valuing the currency unit, giving the currency the price at which you'll buy and sell it. But you can buy and sell it for some high AAA. I don't know whether the U.S. debt would still be AAA by the time. Say something to people for that. The shift from dollar to SDR, international reserves, payments, and Indies, we give the world a more stable currency for all of these purposes. These purposes being payments and assets and stores of value and so on, debt. This would further promote trade because of more efficient cross-border payments, and has gotten into how having an internationally issued currency would give cross-border payments the potential efficiencies of a domestic payment system operating across the domestic central bank. But that would take too long. This would further promote trade because efficient cross-border payments, thus further lifting incomes around the world. Being an internationally issued currency, potential for its political abuse by the U.S. could be greatly reduced. The reduction in this way of the role of the dollar as a reserve currency would be win-win, except for the U.S. Treasury. It would provide for a more stable and more efficient international trade and payments. It would help demilitarize money, and it would modestly increase the cost of U.S. debt finance, hopefully encouraging more careful spending. 31 countries currently peg their currencies to the SDR, and 7 use the dollar itself. They would presumably peg to the SDR. Should it replace the dollar as the dominant reserve currency. If more countries adopt the SDR peg, we could return to an improved gold standard-like international monetary system. However, the SDR is not ready for this goal until the private sector use of the unit that I described earlier is much more fully developed. Thank you.
This is the first time we've done this with Zoom, so the actually even looking at. So Warren, it was cruel acceptance of the casual invitation that Warren offered to try to make us financially literate on the reserve currency, and so that's why we went into some depth and the nuts and bolts of this. And there's Max. Can you put the unfortunately, the founders didn't have Zoom, so there's John Pratt. John used to be on our board. John is in Panama, right? John, are you unmuted?
Yeah, am I unmuted?
And John, just before you say something, there is a significantly more fleshed out and more detailed paper that covers the same thing that will be made available.
It's linked to the invitation, and we'll get to the video.
Okay.
So John actually traded. John Pratt actually was spent years in the foreign exchange market, and he's offered another cruel acceptance to explain to us the euro dollar market, which are the dollars abroad as opposed to the dollars here, the size and importance of that. So when we talk about the reserve currency, we're really talking about the euro dollar market and the size. So John, can you give us a little background as explain your experience and
Sure.
how that fits with what Warren has been talking about?
So basically, John asked that I give a little background on the euro dollar to sort of give context, I think, to what Warren was saying. But the topic is pretty large, so I'm sure we'll end up doing an entire salon on it. But to start, originally the term euro dollar was used to describe dollars deposited in European banks, but became applied to dollars deposited anywhere outside the United States. For example, some people were referring to Asian dollars, but Asian dollars are effectively euro dollars because by definition, they're outside of the US banking system. The euro dollar market is by far the largest source of global finance, notably in 3 areas. The financing of trade, imports and exports, commercial loans, sometimes swap back into the borrower's local currency. We saw that later on with sovereign loans in the euro dollar market, where, for example, Argentina borrowed euro dollars on the theory that they would be generating dollar income from their wheat exports so they could pay back the loans. Of course, we saw what happened there. Same with Mexico, same with Brazil, big borrowers in the syndicated euro dollar loan market. And the third area, which is probably the most interesting, is the interbank, principally the interbank lending and borrowing short term for liquidity purposes as far as the banks are concerned, and as far as non-banks, short-term placement of funds. And this is because many countries lacked the kind of flexible, broad, and deep local money market instruments that the US had. So the eurodollar was a perfect environment for those countries lacking such domestic money market instruments to participate in. So lots of dollars were circulating, recirculating endlessly between banks as they balance their daily liquidity, much like what you see in the US with their repos and so forth. And additionally, it must be said there was a lot of commingling between domestic dollars and offshore euro dollars by the US banks themselves. The whole system is a very bank-centered system. It's based on electronic ledger entries. London is the biggest center, followed by Cayman, Bahamas, and places like that, where you have generally light touch regulation, they call it. Although post GFC, the global financial crisis, more oversight by central banks, and including the Fed, did arise. I would argue, and others, that the euro dollar and not the domestic dollar is the true reserve currency. Euro dollars are used in the largest market in the world, the foreign exchange market, which by volume has a daily turnover in excess of $6 trillion. And of that $6 trillion traded every single day, 88% of all those currency transactions have the US dollar on one side of the trade, compared, for example, to the euro, which is 32% of transactions has the euro on one side. And I'd like to give an example of how the foreign exchange market functions, because it raises some interesting points. So let's take an example of a Mexican importer of Swedish machinery. Now, there is no Mexican peso, Swedish kroner currency market. Doesn't exist. So what does exist? A dollar peso market and a dollar kroner market. And why do both markets exist? Because Mexico and Sweden hold and use, as Warren indicated earlier, dollars in its reserves. And it is used in various other kind of transactions that I've outlined before. So the Mexican importer goes to his local bank and says, I have my pesos. Could you please sell them and buy 10 million US dollars? And then once you buy those, simultaneously sell those $10 million and buy Swedish kroner. So the bank does these two transactions, and effectively the Mexican importer has used his pesos to buy the kroner necessary to pay the Swedish machinery exporter. And the dollar in this example is $10 million. And let's say it was perfectly 10 million on both sides, does not physically enter or touch the US banking system. It served only as a vehicle or intermediary for the two transactions. Now, if that kind of foreign exchange transaction can occur without touching the US banking system, just as an aside for discussion later, what does that say about the effectiveness of sanctions on the Russian ruble, for example? But I'll leave that for later on. And this brings me up to what Milton Friedman wrote back in 1969 about the Eurodollar market. Eurodollar banks, like US domestic banks, are part of a fractional reserve banking system. And as we recall from our EC 101 days, banks create money by taking a deposit, and through the multiplier effect, creates credit. But Eurodollar banks are not subject to reserve requirements like US banks, although they do keep a prudential reserve in order to meet deposit withdrawals and, of course, maturities on those deposits. But Friedman says it's the failure to understand this key point of fractional reserve banking that results in the mistaken belief that every dollar held outside the United States has a corresponding dollar inside the United States. It does not. Hence, Friedman argues that the Eurodollar market has been responsible for raising the world's nominal money supply of dollars. And I think we know where that's going. Now, the growth of the eurodollar market was stimulated by many factors. So a lot of people would like to start and say, well, the Marshall Plan brought $13 billion after World War II, and some, and it's not known what quantity, but some of those dollars stayed in European countries, including some communist countries like Russia. And Russia, who recalled that back in 1918, they had their dollars in the United States seized through something called the Trading with Enemy Act, decided, well, we're not going to keep the dollars in a US bank. We're going to go find a European bank that we can deposit the dollars. And that's one story. Obviously, there are many others of how the eurodollar market got its boost. Another boost was done in the 60s when the Swiss National Bank, which was increasingly getting an excess of dollars in, rather than demanding gold for it, as they had done, because of the quantity of dollars that they had accumulated, they reached a deal with the United States to not exchange those dollars for gold, but to place them in the eurodollar market, where the interest rates were more attractive than the domestic market. Then another push came with the Vietnam War and inflation, which created balance of power, payment problems, which forced the Fed to apply Regulation Q, which, if you remember from the 1933 Federal Reserve Act, was a cap that the Federal Reserve could place on the interest rates paid on bank deposits. And by applying these Reg Q, which was an effort by the Fed to crack down on bank lending, it made eurodollar deposits much more attractive because those rates were not capped under Reg Q, because Reg Q didn't apply to eurodollar deposits. Then we can mention also the Saudi decision or push to invoice oil in dollars in exchange for the U.S. providing military protection, et cetera, et cetera. So those are just a few examples of how the eurodollar market grew in size. And the question is, what size? The only sort of study that people seem to cite is a 2016 study saying that it's a $13 trillion market. But it's constantly changing every single moment, so it's a very hard thing to quantify. But many people would say that it is at least equal to the money supply size of U.S. domestic dollars. I would also just add that the eurodollar market and the dollar reserve currency function performed very well for almost 4 decades as we had global economic growth and global credit expansion. This stopped abruptly in 2007, 2008 with the financial crisis, the global financial crisis. By the way, a lot of people think that that was caused by subprime, by the subprime mortgage crisis. It was caused by a liquidity crunch crisis, shortage of dollars in the eurodollar market. Because as you remember, it was Lehman London that started the ball rolling on that crisis. Of course, there were some other events prior. But the worry by some observers today is that the slowdown in global credit expansion that we have seen since the global financial crisis is causing cracks in the global monetary system, which need to be corrected if we're going to avoid another global financial crisis. As an example, we have already indications of the shortage of dollar collateral. Right now, institutionally speaking, you can borrow yen, swap it into dollars, and save 20 or 30 basis points in funding cost versus borrowing in straight dollars. But the reason why no one is arbitraging that is because of the collateral that's necessary to put up against the currency swaps. So that is an unusual phenomenon that we also saw, of course, in 2007. And that, without getting overly complicated, I would just refer you to one thing that sort of reinforced what Milton Friedman was saying about the misunderstanding of the eurodollar market. Washington Post today has an article called "Russia Exploits Two Big Holes in Financial Sanctions." And somewhere down the middle, I copy pasted it here, says what the US counts on is that payments in dollars ultimately have to touch the US. That is because at some point, US central bank reserves need to be transferred to match the movement of funds in the banking system, and that can only be done with the involvement of US clearing banks. That is outright false, as Milton Friedman has said. So we have a misunderstanding and not a very clear education on the entire complexity of the eurodollar ecosystem. And on that, I think I'm going to conclude so I don't keep people from their dinner.
That's it.
I was going to ask you about cryptocurrency and the movement to move away from currency to cryptocurrency space itself. And for people that want to move back from cryptocurrency into regular dollars, and where do you see that?
It's very important when discussing it to distinguish the cryptocurrency from digital technology. Okay. I'll personally, all of my payments are made digitally these days.
But not in cryptocurrency.
No,
Right.
in dollars, and that's the important distinction.
Yeah.
Currency and the means of paying that currency.
Okay.
So the digital technology is applicable to any currency.
Okay.
What most people think of when they think of cryptocurrencies is something like Bitcoin,
Right.
which has a value that is determined fundamentally a different way than the value of the US dollar. Or certainly what I am proposing are currencies that are firmly anchored to something real. So the price of the currency is defined. I'm sorry, but for some reason I'm a bit out of breath. But what gives currencies that are unanchored, like the US dollar, their value is the public's demand to hold them because they have to have them to make payments in them. And in the case of Bitcoin, should it be widely adopted for making payments so that people had a stable demand to hold them to make those payments, it could have a stable value. At this point, that doesn't exist. It's basically a speculative roulette wheel where people are betting on whether it will go up or down. So so let me summarize this one.
Yeah.
The technology for digital payments is fully available for the dollar or anything else that is increasingly widely used. So that's all good. I do not imagine at all that Bitcoin will ever become a stable currency. It's hard to see how it would outcompete the dollar for being able to make payments for everything.
Warren, I wonder if you could reply to what I think would be the biggest argument against using this. That would be,
almost hear it on Capitol Hill. Some world government is issuing this money over which we have no control, even if the dollar is included. So if you take that, and indeed, that would, your argument, I think, implies that the International Monetary Fund would be more powerful than it is today. It would have to be, after all, this is an invention of the IMF. Isn't it more likely that we're going to have a competing world currency if the dollar is today's world currency? The renminbi, the Chinese clearly see long-term as a rival. Isn't that more likely?
That requires a speculation that's hard for me to do, but I'll tell you why I think the SDR would be superior. One is its supply would not be regulated by the IMF or any other issuer. It would be totally determined by the market. That's a currency board rule. That's what a currency board means. The role of the SDR, the role of the IMF would be in defining the anchor to which the value of that SDR is fixed. And the IMF already has a very well defined, very transparent process every 5 years of reviewing the components of the basket, adjusting the amounts, changing the currency if necessary, such that on the last day of the old basket and the first day of the new one, the values are identical. I mean, they're fixed such that the transition introduces no change. The change comes in the trajectory going into the future if you change the basket. So I think that speaks well for how the Federal Reserve, the ECB, and other central banks now operate, and would be superior. Let me, I don't know why I'm so out of breath. Let me give an example of the adoption of the currency board in Bosnia. 3 different ethnic groups were at war with one another, vicious, nasty war, and we created a central bank of one currency for the region. And they each had their own currency. In the discussions between the 3 groups of adopting the new rules for the new currency, there was zero controversy, zero discussion over currency board rules, because they didn't need to trust each other. If they abided by currency board rules, they wouldn't trust anything else. So this is a feature of currency board rules, which is why I think an internationally issued currency following currency board rules would be superior to the dollar.
So we picked the SDR is a very complex thing, the reserve currency. So we picked it as a runway in on the subject. So when you get into the SDR, it raises the question of what the reserve currency is doing, the holding the value. So Warren, I asked him what probability he put on it, and he said like 5%. I put 0. And the reason I put 0 is because the 2 political parties enjoy the benefits of reserve currency. So it allows us to use it as a weapon and allows us to borrow money without discipline or constraint. So I think they would stop this thing to do that on arrival. But it's a very valuable tool. It's a nice way of Warren's advocacy. This lets us get in and start to see the power of what the dollar is.
But you have to keep in mind that it's not the U.S. Congress or the U.S. government that makes that decision. It's the rest of the world that decides what they want to hold. And you're seeing them now looking around awfully hard for something other than the dollar.
If you're going to change the IMF treaty, the Senate would have to agree to any amendment to the treaty. So, and you explained that you need to adjust your current articles to have the regime of SDRs that you've identified. How do you evade Senate ratification?
You could get most of the way to where I think it would need to go for the SDR to replace the dollar without a change in the articles. That is, sticking with the current procedure for determining the currency basket. But to go whole hog and get rid of the currency basket and eliminate allocation, that's a sort of a final step, not totally necessary, but I think desirable. Whether the U.S. they can do that if they want.
Thank you for your comments, Warren. I'm very familiar with the currency board concept. Are there any currency boards currently active? Because my impression is that basically they don't last very long, and then things go haywire.
Yeah, Bosnia, there are 5 or 6. Bosnia.
Currently active.
Yes, absolutely, highly successful. I was on the board of the Monetary Authority of Cayman. It's a currency board. Bulgaria is a currency board still. All of them have been extremely successful. They don't generate much discussion because they work so well, so transparently.
Let me come back to a more basic question that relates not only to the currency boards, but also to the notion of widespread use of the SDR. And that is, if you have, as with the SDR, that it is reflects the value of a basket of currencies. The question is, over time, how do you adjust the basket to reflect the fact that you have changes in economic growth rates, for instance, in different countries that make up the basket? And it may be possible that you're able to to finish my question. It may be possible in an SDR context to change the makeup of the basket, but for a broad global use of the SDR, doesn't it become very contentious to try and change the mix of currencies in an SDR basket as economic conditions vary across various countries?
Well, they do it every 5 years.
But that's in the present arrangement. But it was used globally.
It is used globally, but it's not very widely used in the private sector.
Right. So that's my question, is if it became widely used in the private sector, then what kind of issues would arise in the periodic necessary adjustments in the makeup of the basket?
None that I can think of. What happens in the private sector is that whatever the basket is, whatever the daily market value is, in terms of dollars and currencies of that basket, private use of the unit, whether it's a bond or a deposit in a bank, or denominating the price of oil, however you use it, however widely it's used, doesn't really raise any challenge whatsoever to the process by which the basket's composition is reviewed and adjusted every 5 years. It's a very transparent, very fully specified process by which they review the composition of the basket every 5 years and make adjustments if and as needed. That has no implications whatsoever that I can think of for the private sector's use of that unit. The more they use it, the merrier. It doesn't change the characteristics of the basket.
I should introduce myself. I'm Paul. I was the Chief International Economist of an old-fashioned investment bank, which no longer exists, called Smith Barney. We earned money the old-fashioned way. We also earned. I have a couple of things to say that I think John Prout was going to mention, and that is there are some very distinct advantages to having dollar the main reserve currency. One is it means our external deficit has been financed since 1981 by the voluntary capital inflows from other countries and other investors who deemed that the U.S. the U.S. dollar was a better bet than their own currencies. So what that has meant over the years is that our interest rates are much lower than they would have been if we had to pay for the money ourselves with our own savings. Two, it meant that our taxes are much lower than they would have been if we had to finance our own deficit. So there are real advantages to having the dollar as a reserve currency. What Warren is suggesting has been suggested a number of times, and the basic contradiction is that it means that an international body would be establishing fiscal and monetary policy for each country using the SDR. Either that or the SDR would have to be adopted by each country, or you would have national currencies for each country, and then you have to figure out how an international body like the IMF would establish monetary and fiscal policy for each country, including the US. If the SDR were to be adopted by the US as its currency, then we would never give up our controlling vote in the IMF, which we have currently, and which we use forcefully. So there are a couple of other problems, and one is Warren suggested shifting the international SDR or the market SDR that he suggested from the basket of 5 currencies to a basket of 5 to 10 commodities, this including perhaps gold. What this would do, it would give an extraordinary advantage to the producers of those commodities, notably Saudi Arabia, which is dominant and determining factor in the oil price, which is a global fungible price. If the oil price goes up anywhere in the world because of production outages, because Russia reduces its supply, our gasoline price will go up accordingly, period. There's no alternative to that. Similarly, so that would give Saudi Arabia an enormous advantage. The gold producers, who would be South Africa and Russia, would also have an inordinate advantage in controlling the production and price of gold and so on. So after World War I, there was a big battle, which John Keynes won because he demonstrated the gold standard or any commodity-related standard for the international monetary system would not work. We needed a flexible source of credit and money, which is what we've had since Nixon delinked the dollar from gold in 1971. And that has proved to be a very flexible instrument, that is, having flexible markets. So we have a flexible system which is determined by the market, and that means not just the US. And the dollar is a reserve currency, as I said at the outset, because it is based on liquidity. It's based on the largest economy in the world, which Bitcoin was not, never will be. I was at the session on Monday and Tuesday of the National Association of Business Economics, at which Jay Powell spoke at lunch, at which got frontline headlines. And in fact, he pointed out that the Fed reacts to the external pressures, including inflation and supply and demand. So we have that advantage. And foreigners, for the time being, continue to deem that the dollar is the way the store of value, which they would prefer to hold. That continues to be true, even for the Japanese, Chinese, who are the largest financiers of our deficit, keeping down our interest rates and keeping down our taxes. So if you wish to get rid of the dollar, you have to think about at what interest rate would attract enough U.S. savings, inadequate as they are today because we overconsume. 69% of GDP goes for private consumption. We do not save enough. We are totally dependent on foreign capital. So our taxes would go up, our interest rates would go up if we get rid of the dollar. Anyway, those are a few observations from somebody who made his living as a market economist, not as a theoretical economist. My apologies, Warren.
I'll try to remember as much of that as I can, starting backward with Keynes. With currency board rules, we most certainly would give up the discretionary monetary policy that the U.S. and most other central banks now have. I argue that those are not helpful, that the decisions of the central bank about whether to raise and lower interest rates or increase or decrease liquidity and so on though they are mandated to do those things in light of price stability, in light of a 2% inflation target. So that's a good thing. It provides a bit of discipline. But the advantages that you are suggesting of that system, I don't believe in. And I think a market-determined system where there is no money supply, no monetary policy. The central bank does not have a monetary policy, just fixes a price and lets the market determine is a superior system. And as I said, it is working very well in the countries that have it. I would characterize, I did outline that the advantages to the U.S. of the reserve currency was that it got a lot of foreign financing instead. But I characterize that in a different way, and who knows how our politicians would actually operate. But I am arguing that in the absence of so much foreign financing of fiscal deficits, Congress would be more disciplined and run lower deficits. So I don't anticipate interest rates being jacked up so much. I anticipate government debt going down. But it could go either way. And I enumerated that as one of the advantages of the reserve currency role of the dollar. We got a lot of foreign financing for the fiscal deficit. It is absolutely just not right that replacing the dollar, that's what we focus on, with SDRs for international payments purposes would require anything with regard to fiscal policies in individual countries that might use the SDR rather than using the dollar for their international transactions. It just doesn't follow. Furthermore, if countries did fix their currencies to the SDR, and I'm assuming that this would begin with those countries that now fix their currency to some other currency, the US dollar or the euro, or that they have a fixed exchange rate regime. For such regimes, it's certainly the case that monetary policy is subservient to that fixed price. And that would be true whether it's the dollar that it was fixed to or to the SDR. So the SDR, the international use of the SDR, replacement of the international use, even domestic uses by fixing domestic currencies to the SDR, does not have any implications for fiscal policy, other than, in principle, countries who fix the exchange rate of their currency to the dollar or something else, in principle, should be subjected to greater fiscal discipline. But that already exists for those countries that do fix their currencies to something else already. So shifting from a dollar, fixing it to a dollar, to fixing it to an SDR, I just see as an improvement. I'm sure I missed 4 or 5 other points that you made. Those are the ones that I remember.
My question is, do you have any comments on the reserves for Afghanistan that are held in the United States, how those reserves have been used? Do you have any thoughts on how those reserves have been appropriated for the 9/11 fund, and whether or not that is a breach of trust?
I think we can ask that question.
That's right word.
Yes, thank you for giving me the chance to vent on that. Let me contrast the Afghan reserves from the Russian reserves. In the case of Afghanistan, with the fall of government, the foreign exchange reserves of Central Bank of Afghanistan at the New York Fed or wherever they were rightly frozen until new ownership could be established. Because the owner cease to exist. It's like, you know, if your parents die, the estate is frozen until legal process verifies who the legitimate new owner is. So freezing those things until the Afghan government recognizes is an appropriate thing to do. But it appears, and it is so shocking that I'm not sure that it's actually happened, but it appears that the U.S. government has confiscated, not frozen, but confiscated those reserves, plans to give half of it to 9/11 survivors or something, and then allow the rest of it to be used for the benefit of Afghans. That's pure theft. That is simply outrageous. And my Afghan friends, I mean, having worked there, I'm sure you get dozens of emails every day. Every day, I know it's extremely painful. But I mean, they were just beside themselves. You know, I mean, Bin Laden's not an Afghan. He didn't live in Afghanistan. He lived in Pakistan. You know, what's going on? You know, what's the basis for this theft? It is just absolute theft. It can't. I don't think it can survive legal scrutiny. Now, in Russia's case, there's no justification for freezing them in the first place, because the Russian government hasn't changed as much as we dislike it. They would like to see the government change, but it hasn't. So there's no justification for freezing those, and that's a militarization of the dollar that many in the world are now objecting to and looking for other alternatives. So it's not up to the congressmen on the Hill to continue with their nice benefits. They'll just get dumped, you know, if the world finds suitable alternatives to not be subjected to that kind of illegal behavior on the part of the United States.
Or could I just, on the legality issue, the president's order cites the International Emergency Economic Powers Act, 1977, which, without defining an economic emergency, endows the president with limitless discretion to do whatever he wants to interfere with any economic transaction. It was tested in part in the U.S. Supreme Court in James and Moore versus Reagan, relating to all the transactions relating to Iran that were blocked while our hostages were held in Tehran. So why is this not authorized by the International Emergency Economic Powers Act? It places no limits whatsoever on the president's ability to interfere with economic transactions.
Thank you for that clarification. What you're describing is why the president may have acted legally in terms of U.S. law. He's absolutely illegal in terms of international norms.
Is it a violation of IMF rules? Seize reserves of Russia.
I don't know.
Warren, that was very magnitude cost to the public in terms of switching from the dollar to the SDR. So let's assume the SDR has taken over 50% of the US dollar reserve situation. Do you have a sense of how much of an increase that would involve in terms of US treasuries and what the total cost to the US economy, if that would occur?
It's a very good question, and it reminds me of another comment that Paul made. I described all too briefly indirect redeemability. I described getting rid of buying and selling gold or oil or whatever might be in the commodity basket. So the objection that you raised about increasing oil prices or increasing commodity prices is not correct, because they would not be demanded for purposes of this currency. They would only be used as a benchmark, as defining the value. It would not affect the supply and demand for oil or anything else in the basket at all. Your question of the transition, it's a good question. Let me sort of lay out how I would see the transition most likely happening. As the world transitioned from dollars to SDRs, if that happens, let's assume it happens overnight, just to make it simple. Basically, the existing stock of international reserves would be there. The treasury bills that were purchased in that stock would still be there. So the lending that was done up to that point by the rest of the world to the U.S. government, those loans would still be there. But rather than their backing U.S. dollar denominated reserves, they would transition it to SDR denominated reserves. The underlying assets up to that point would be the same. It's really in going forward as new SDR reserves are accumulated that the U.S. would be deprived of the future flow of more financing and funding of the U.S. debt. But the existing stock has already been made.
Warren, how many basis points are we talking about in terms of increased borrowing costs for the U.S. if it went to SDR? How many basis points? Estimate.
That would depend on future U.S. debt. If Congress continue to run deficits of the size they're currently running, then whether you switch to the SDR or not, interest rates are going to rise. Now, if you switch to the SDR so that little or none of that financing is coming from abroad, then interest rates would be pushed up even more. But I can't guess what that is. But it's completely dependent on the size of the government's borrowing, the size of the deficit. So if they want to keep the interest rate impact small, they should run a small deficit. Whether it's financed abroad or not financed abroad, if they have a smaller deficit, they have a smaller financing.
I think in my observation, it seems to me that if you have half the U.S. ships over to SDR and you still have the dollar, then if you have free markets, that's a question I think you have to address. That is, you allow capital markets to shift as they will, depending on the perception of the oil price. And if you fix the oil price, the gold price, and the palladium price, the lithium price, and so forth in your basket, you're going to see markets saying, I'm going to fix those. I'm going to change those market prices as opposed to the SDR price that you have fixed. Therefore, you're going to have an arbitrage between the market price and the SDR fixed price. Ditto for a U.S. which is running 50% dollar, 50% SDR. If you accept free market operations, you've got to somehow make that possible. The other point is that if the U.S. has to finance its deficit because politicians are not quite as obedient as you seem to think they will be, then you've got to come up with the savings. And we have completely inadequate savings. National savings, meaning the private savings and institutional savings, corporate savings, and government savings. We save totally inadequate amount, which the foreign investors make up for us.
Okay, let me explain the valuation basket again because you're not understanding it correctly. It does not fix the price of oil. It does not fix the price of anything in it. So the free market is not interfered with in any way whatsoever. The oil market is not interfered with in any way whatsoever. It is only used as a benchmark. You say that just take gold. That's simple. One commodity. If $1 is defined as an ounce of gold,
the market price of gold will be whatever the market price will be. But in terms of dollars, the value of a dollar will be an ounce of gold. And therefore, this does, with indirect redeemability, i.e., the monetary authority is not buying gold. It's not selling gold. It's not storing gold. It doesn't touch the gold market. Gold market is whatever it wants to do. However, if anyone finds that you can buy gold in the market or cheaply, then you can buy it from the central bank. Then you'll sell some of your dollars back to the central bank and buy their gold and sell it for a profit in the market. So that's the arbitrage mechanism. It doesn't do anything for the price of gold in the broad sense, but it regulates the supply of money. It regulates the supply of dollars in order, if you're following currency board rules, describing currency board rules. That is the way the market, through this arbitrage mechanism, adjusts the supply of currency in the market in order to keep the market price of that currency consistent with the official bank price. That does not interfere with the supply and demand for gold at all, or oil, or anything else that you might put into that valuation basket. There's no touch of free markets. That requires saving. Okay, I mean, if you don't have inflationary factors, if you don't have the central bank creating liquidity when the private market didn't save enough, then your saving is limited. I mean, your investing interest rates are determined by the supply and demand for saving. So this is how markets with currencies with a fixed anchor. I mean, most of the currencies in the world are fixed to some other currency, so they already have that system. But I'm shifting from what they now fix to fixing to the SDR.
You take a position now, study between the two kinds of behavior that you don't want reserve currency first, but the utilization. Reserve currency in terms of no limits on borrowing until the borrowing stopped. Said no. Versus the weaponization. Is there any use of the weapon ever approved that or principally? How do you weigh the two?
If the dollar were replaced by the SDR, it would be much harder for the United States to interfere with payments in a country they didn't like by forbidding the use of the dollar, because the dollar wouldn't be the primary means of payment across borders. I think personally, I'm awfully glad that we are trying to punish Russia through sanctions rather than by sending our troops into Ukraine. However, so that's an improvement. The sanctions still bother me, but are easily abused, squashing the Russian economy, which we are in the process of doing. I think we will live to regret 5-10 years from now. And the analogy that I give you, I'm a big foe of anti-money laundering regulations. What anti-money laundering regulations do, or attempt to do, is to identify profits of illegal activity and then trace where they go to try and interdict the people who are profiting. The problem is that they are claiming that these are the proceeds of illegal activity, which they may well be, but which have never been proven as illegal. If If the activity generating the profit is illegal, it's far better, in my view, than a rule of law frame of mind to directly try the illegal activity, arrest the people conducting the illegal activity, and prove in a court of law that what they're doing is illegal. With anti-money laundering, you're simply declaring, we know that this money was illegally gotten, even though we haven't been able to prove it in a court, but we know it is, and so we're going to enter the money. To me, that's in the spirit of sanctions, monetary sanctions. A more direct way, which is actually more effective, we see a lot of companies pulling out of Russia for business reasons as their way of protesting Russia's bad behavior. That to me seems more honorable, and it's also more directly effective. You know, it's not indirect by not being able to pay for it through the payment system. It's you can't buy it or sell it. So anyway, you know, this is all complicated stuff.
The ability of the United States to try crimes that are in countries that are lawless is ridiculous. The reason why you have anti-money laundering, you're going to go to these countries, they have their own sovereign system. We can't get in there. The FBI can't walk in there and do investigations and get search warrants and have a neutral, independent judiciary. It's the countries that are completely lawless that are the source of trying to launder the illegally gotten gains. And to suggest, well, we should just take over their court system and try them, it's totally unfeasible and ludicrous.
One last question.
There is kind of financial indicator, so please give me started by keeping my intellect and ended by keeping my passion. The internet comes with the cryptocurrency thing. I am wary of investing in what you call anchored currency since as a scientist I don't understand currency. But cryptocurrency, where everyone keeps on telling you to invest in Bitcoin, etc., I refuse to do. So I was happy to hear what you have to say, and I hope I understood you properly. However, my passion as an Afghan American who works in war and conflict right now dealing with Ukraine and Afghanistan, thank you for addressing my problem, which is ordinary Afghan suffering. But please remember 9/11 is not fostered, created, and implemented by Afghans, but by our good friends South and a few of their Arab, cohorts. So thank you.
Well, we've got to thank you so much.
Okay, I think everybody, can you hear me? It looks like they muted the salon.
Possible to ask a question?
Yeah?
I've been struck, I'm not an economist, but I have done a lot of systems analysis and observing. I've been very struck by the whole issue, and I wonder if you see an analogy to the related question currently discussed in Congress recently of the time zone changes and the way they would like to have a reliable standard of time other than having to switch the clock twice a year.
Yeah. And
well,
you're asking what is the effect?
There's a lack of a backing standard. The only standard that exists on Earth is the sun and the rotation of our Earth. But they've gerrymandered that when you look at a map of the time zones on Earth, there's incredible zigzagging to accommodate to trade and so on. And I've been very struck by how similar it is to the whole issue of the dollar having been taken off the gold standard.
Well, I think the time zone zigzag lines that you see in Europe are probably pushed by the agricultural lobbies because of the farmers.
That was also what happened with the daylight savings. That was to accommodate both farmers and miners, mining companies.
Yeah.
In other words, the natural order of time where every longitude was the same across the Earth was changed in order to accommodate something somewhat unnatural, to accommodate a trading of some sort. And it sounds as though, having been removed from gold, which has a limited supply on Earth, that we've done something similar, which is a little bit unnatural.
Well, I think the argument against gold as the backing of the dollar is, as you just pointed out, it's a limited quantity. And therefore, by definition, as the world economy grows, let's say, pick a number, 3% a year for the next 100 years, you are, with a fixed dollar amount supporting it, by definition going to devalue or depreciate that dollar, because the global economy demands more dollars because it's grown, right? So it's a bit like Bitcoin. There's a fixed supply of 21 million coins. So, sorry? So it appreciates, so the, yes, my wife in the background corrected me. So the dollar in that example linked to gold has to appreciate, just like Bitcoin appreciates due to the fixed supply as demand for it increases. And that demand for the dollars in the example of growing 3% a year for the next 50 years creates more demand for dollars, but it's fixed because of the amount of gold that's behind it. So the price of the dollar has to go up.
Well, that also had to do with the fact that there was a fixed amount of sunshine for the for the agriculture with each meridian of longitude. But in changing the zigzagging of time zones, it allowed people to have the same hour for dealing with business in the day, but a greater area of Earth to do the amount of commerce.
Yeah.
Was then included within the changed lines.
Yeah. I'll have to take a pass on that one. Someone is asking me about the prospects that Russia will back the ruble with gold. Russia has an awful lot of gold relative to several years ago, because it's been bringing in a lot of gold back and purchasing as well. I'm not sure it would have as much global impact. It would certainly have an impact with Russia's trading partners, probably such as India or some of the stands or in the Middle East. But it's Russia going to back the ruble with gold is not going to suddenly convince the Americans or the Europeans that they should do something similar. So I don't see much of a consequence, other than for the people who have of course, the value of the ruble would increase. There's no question about it. And in fact, as you've seen already, the ruble has, let's see, from 150, it went back down today to 105. So it's already recovered from the bottom about 28%. Now it's still down 25% or so from the beginning of the year. And let's not forget, Russia is still getting dollars for its oil.
All right, that's all we have time for. They're kicking me out of the club. Thank you very much again.
Okay, thank you. Thanks, everybody. Bye.